Investing, at its core, is about navigating the balance between risk and return. Like two sides of the same coin, they are inextricably linked. Higher potential returns often come with higher potential risks, and vice versa. Understanding this fundamental principle is crucial for any investor seeking to make informed decisions. This delicate balance between risk and reward forms the foundation of successful investing. Imagine you have two investment options: a government bond and a stock in a new technology company. The bond is considered relatively safe, offering modest but consistent returns. The technology stock, on the other hand, has the potential for explosive growth, but also carries a higher chance of losing value. This trade-off between risk and return is a constant in the investment world. Investors must carefully weigh their risk tolerance, investment goals, and time horizon to make choices that align with their individual circumstances. Understanding how much risk you are comfortable taking is essential for making sound investment decisions. In the realm of investing, quantifying risk is essential. One widely used tool to measure risk, specifically volatility, is beta. Beta provides investors with a numerical representation of a stock's or mutual fund's price movements relative to a benchmark, typically a broad market index like the S&P 500. Think of beta as a measure of a security's sensitivity to market swings. A beta of 1 indicates that the investment tends to move in the same direction and with the same magnitude as the market. A beta higher than 1 suggests greater volatility, meaning the investment's price is likely to fluctuate more dramatically than the market. Conversely, a beta lower than 1 implies lower volatility, indicating the investment's price is expected to move less drastically than the market. Investors use beta to assess the potential for both gains and losses in their portfolios, making it a valuable tool for managing risk. The risks associated with an investment are influenced by a complex interplay of internal and external factors. Internal factors are specific to the company or entity issuing the security. These factors encompass a company's financial health, management quality, competitive landscape, and industry dynamics. External factors, on the other hand, are broader economic and geopolitical events that can impact the market as a whole. These include interest rate changes, inflation, economic recession, political instability, and global pandemics. Understanding both internal and external risk factors is crucial for investors. Analyzing a company's fundamentals, such as its earnings growth, debt levels, and competitive position, can provide insights into its inherent risks. Simultaneously, staying informed about macroeconomic trends and geopolitical developments helps investors anticipate potential market volatility. While beta is a widely used risk metric, it's important to acknowledge that it is not the only measure available. Investors have a range of tools at their disposal to assess and manage risk. Standard deviation, for instance, measures the historical volatility of an investment's returns over a specific period. It provides a sense of how much the returns have fluctuated around the average return. Another important measure is the Sharpe Ratio, which considers both risk and return. It calculates the risk-adjusted return of an investment, taking into account its volatility relative to a risk-free rate of return, typically represented by government bonds. Additionally, investors often analyze a company's financial statements, including its balance sheet, income statement, and cash flow statement, to assess its financial health and identify potential red flags. By utilizing a combination of risk measures, investors can gain a more comprehensive understanding of the risks and potential rewards associated with different investment opportunities. Section 5. Beta as a ratio benchmarking volatility. To grasp the significance of beta, it's crucial to understand that it is a ratio. It compares the volatility of a particular investment, such as a stock or mutual fund, to the volatility of a benchmark, usually a broad market index. This benchmark serves as a proxy for the overall market's movements. For example, if a stock has a beta of 1.2, it means that for every 1% move in the benchmark index, the stock's price is expected to move 1.2% in the same direction on average. Essentially, beta quantifies how much an investment's price is expected to fluctuate in relation to the market's fluctuations. This relative measure of volatility is a key concept in understanding beta. It helps investors gauge how much risk an investment adds to their portfolio compared to the overall market. By comparing betas, investors can identify investments that align with their risk tolerance and investment objectives. Section 6. Decoding beta values from low to high. Beta values can range from negative to positive, with each value having a specific interpretation in terms of risk and volatility. A beta of 1, as mentioned earlier, indicates that the investment tends to move in line with the market. A beta greater than 1 suggests higher volatility. For instance, a stock with a beta of 1.5 is expected to be 50% more volatile than the market. This means that for every 1% move in the market, the stock's price is anticipated to move 1.5% in the same direction, on average. Conversely, a beta lower than 1 implies lower volatility. A beta of 0.5, for example, suggests that the investment is only half as volatile as the market. For every 1% move in the market, the investment's price is expected to move 0.5% in the same direction, on average. Negative beta values, while less common, are also possible. A negative beta indicates an inverse relationship with the market. For example, a beta of -1 means that the investment's price tends to move in the opposite direction of the market. Section 7. Utilizing beta in mutual fund selection. Beta can be a valuable tool for investors when selecting mutual funds. By considering the beta of different mutual funds, investors can align their choices with their risk tolerance and investment goals. For instance, an investor seeking aggressive growth might opt for a mutual fund with a beta greater than 1, indicating higher volatility and the potential for higher returns. Conversely, a more conservative investor might prefer a mutual fund with a beta lower than 1, suggesting lower volatility and a potentially smoother ride. By understanding the beta of a mutual fund, investors can gain insights into its potential price fluctuations and make more informed decisions about whether it aligns with their investment strategy. It's important to note that beta should not be the sole factor in mutual fund selection. Investors should consider other factors such as the fund's investment objective, historical performance, expense ratio, and management team's track record. Section 8. The limits of beta: a holistic approach to risk. While beta can be a useful risk metric, it's crucial to acknowledge its limitations. Beta is a historical measure, meaning it relies on past price movements to predict future volatility. However, past performance is not always indicative of future results. The market is constantly evolving, and factors that influenced a security's price in the past may not be the same factors that drive its price in the future. Moreover, beta is just one measure of risk and does not capture all potential sources of volatility. Other factors such as company-specific events, industry trends, and macroeconomic shifts can all impact an investment's price. Therefore, it's essential to adopt a holistic approach to risk management, considering a range of factors beyond beta. Investors should also be mindful that beta is calculated based on a specific benchmark. The choice of benchmark can significantly influence the beta value. Using a different benchmark can result in a different beta, leading to varying interpretations of risk. Section 9. Comparing returns and betas, a case study. To illustrate the limitations of relying solely on beta, let's consider two hypothetical mutual funds, Fund A and Fund B. Both funds have generated an average annual return of 10% over the past 5 years. However, Fund A has a beta of 1.2, while Fund B has a beta of 0.8. Based solely on beta, Fund A might be perceived as riskier than Fund B. However, both funds have achieved the same return. This discrepancy highlights the importance of looking beyond a single metric when evaluating investments. It's plausible that Fund A achieved its returns with larger price swings, while Fund B might have experienced more moderate fluctuations. Ultimately, the best investment choice depends on an investor's individual risk tolerance, investment goals, and time horizon. Relying solely on beta without considering other crucial factors could lead to suboptimal investment decisions. Section 10. Disclaimer: Regulatory information. The information provided in this essay is for educational purposes only and should not be considered investment advice. Investing involves risks, and the value of investments can fluctuate. Before making any investment decisions, it's essential to conduct thorough research, consider your financial situation, and seek guidance from a qualified financial advisor. Mutual fund investments are subject to market risks. Please read the offer document carefully before investing. KYC, or Know Your Customer, is one such mandatory requirement for investing in India. As per SEBI, or Securities and Exchange Board of India, guidelines, investors need to comply with KYC regulations to invest in mutual funds. For further details on KYC norms and SEBI registration, please refer to the official SEBI website or consult with your financial advisor.